To a customer, as a provider of a multi-dealer platform, it doesn't matter, but you need the mix. You need the banks with inventory, the non-banks with inventory. You need the instantaneous hedges. And I can show you examples of the last 24 months where all those styles help the customer or hinder the customer. I mean, frankly, the so-called liquidity providers with inventory weren't there when you needed them on October 7th. But you know what? The instantaneous hedges were. I take the point that you couldn't get $50 million or $100 million done, but yeah, once the initial 200 was done, no one was trading in that size anyway. But simply the guys with supposedly risk appetite weren't there. And the instantaneous hedges were there for the vast bulk of the market. That said, the guys in inventory are very good. 23 hours, 55 minutes out of 24, generally. But you need them 24 hours a day. So, to customers, if you're making your own liquidity pool, or you're going to a bespoke liquidity pool, I think you need the mix. And one side doesn't fit all, it will not fit all. And by the way, I also think that we sound the death knell for banks way too early. This is a cyclical thing. And what I've seen, statistics aside, because guess who contributes to the statistics? We've seen formerly second tier, third tier banks coming to the fore. And you're going to see them coming back up and giving the non-banks a run for their money. 3 milliseconds, 10 milliseconds, or 50 milliseconds, people can act on your order before it's executed. It's a simple fact. Now, everyone tells me they don't do it, but it happens. So there's a cost.
Do you have, I know you guys have been looking into this for quite a while, do you have any maybe proof or any studies that you've done?
Sure. So by the end of the year, we'll have an academic study challenging the last one, which was commissioned by an equity guy who proposes last look in FX. So yeah, by the end of the year we'll have it. We've analysed 6 million trades. That was in the first quarter. There's probably another 10 million trades in the second quarter across last look pools and firm liquidity pools. And what we do there is actually come up with a really simple answer to all customers, which is, this is your cost of trading. But back to what the guys have said, you can make the choice. The good news is if you trade on firm liquidity, the customer makes the choice. They can decide their fill rate, 100%. Whereas at the moment, where you trade on last look, the hands are in the decision is in the hands of the liquidity provider and or the venue where you trade.
Right. So sorry, and we can't always agree.
For sure.
Some people might know that. It's really all about choice, right? So it's not about last look. It's about the ability of a customer to have enough information to make a decision as to what the cost of trading is. I don't care what the hold time is and whether in that hold time somebody's last looking me or not, okay? What I care about is what does it cost me to execute? What's the slippage? What's the slippage due to whatever outside market conditions exist? Okay, well, so it's, focusing on one issue.
It's one part of it's one of the metrics that should be measured, which you can measure.
And ultimately to get to what the cost of trading is.
The last I heard, we're talking about 15 to 20 yards a day, I think, in dark pools. Is that about right? So exactly. So I think it's a very, very small percentage of the spot FX market. Now, is there room for abuse in the dark pool? I don't know.
I just wonder, David, if that's just not more of a sentiment about the lack of transparency about what's trading in the marketplace, rather than the actual darkness of a pool, just the inability to see what's trading in multiple exchanges.
So I think that's probably right. I think James is exactly right. So I think probably this audience is saying they don't want more dark pools, but I know a lot of large institutions who want to exchange risk in dark pools. Personally, I don't actually have a problem with it if banks want to exchange risk at the mid under some convoluted rule structure that they have. I don't think there's going to be big growth in it because the world, not just capital markets, not just FX, is going towards greater transparency. Believe you me, if I thought it was going to be a big area for growth, we'd build one because it's technically trivial. But I don't think it's going to. I can't see that being the way going forward. We need to work on liquidity in the marketplace. The reality is a lot of liquidity disappears in a significant market move. I think some of that's down to just the algorithmic nature of trading these days. And the computer does say no. I mean, part of the advice would be to insert some people in the middle of it. If you looked at the S&P, for example, January 15th, I think everyone really knew where Euro Swiss was going to finish. Because dollar Swiss, there was some trades going on, there were euro dollars, some trades going on. But the computer said no and created these crazy bids. 0.34 was one I saw. Luckily enough, it didn't get in. Likewise, every old pro, there's a few of them in the audience, that I called at around midnight on October 7th, said, we have to pay it here, surely, because it looked like it was going to parity. And there was no reason for it, nothing had happened. But it was the computers going into a death spiral. So when human being got in between the computers, they suddenly made a bit of money. So there's risk appetite for you. We're pretty pragmatic, actually. I have to accept all styles of liquidity provision in the market. And I cannot agree that one style is bad and pushes up the cost of trading for customers. That's one size fits all. I can show you a whole ream of customers where the cost of trading has got lower because of that style of market making. What I would say is, both the gentlemen to my right are liquidity providers on our platform. The overall cost of trading to a customer on LMAX Exchange has gone down significantly over the past 5 years. That's just a fact. And that fact is because we have 17 LPs, 23 if I include the interbank platform, using all styles of liquidity provision, some with risk appetite, some without risk appetite, some with microwave, some without microwave. But
So
net, the cost of trading for the customer has gone down, and that's true across the marketplace over the past decade. Bit negative to start with. Europe, paralysis by MiFID II. Second of all, I think you're going to see, because starting on this weekend, the Italian referendum, increased volatility. That's a very good thing for all of us. And I think thirdly, you'll see, because of all of that, the real value of firm liquidity coming to the fore, especially in LMAX Exchange.